retracements and reversals. Now, in tonight's class, I'm going to use the term security, but I also might say Forex, I might say bond, I might say the euro, I might say cryptocurrency, I might say Bitcoin. Doesn't matter. We're not talking about a specific asset because what we're discussing tonight applies to any publicly traded financial instrument in which there's an open marketplace. I also will be intermixing the term investing and trading. Typically, an investor takes a longer term position, while a trader takes a much shorter term position. But in either case, the concepts we're talking about tonight and the techniques presented are equally adept. Now, retracements and reversals are part of the study or the analysis called technical analysis. Now, I'm always asked, should I buy today? What will the prices be in 15 minutes or tomorrow or later today or next week? Now, wouldn't investing be easy if we knew the answers to these seemingly simple questions? But alas, I don't have a Ouija board and I sure don't have a crystal ball. So if you're attending this class in the hopes that technical analysis hasn't answered these questions, I'm afraid I have to disappoint you. They don't. But if you're attending this webinar with the hopes that technical analysis will improve your investing and trading, I have good news for you. It will. Because you remember, trading is all about risk reward and risk management. When to enter a market, when to exit, how to protect yourself with stop losses. And to do that, you have to be able to understand how an asset is moving. Now, reversals and retracements are an ultimate part of deciphering the world of price action. Because when we say uptrend or downtrend, we think that we're talking about a market that's going this way. But in fact, a market doesn't actually go this way. A market moves in an upward fashion with a series of peaks and troughs, peaks and troughs, peaks and troughs, tops and bottoms. And a well-defined trend and a healthy trend consists of these movements up and down, forming higher highs and higher lows, higher highs and higher lows. And if you think about it, the market only has three ways to move. A market be trending upward, it can be trending downward, or it can be trending sideways. Now, just because a market is trending up doesn't mean it's a easy to trade market, because this can be a uptrend, while this can be an uptrend. Okay, a well-defined, if you think about trading, is a series of risk-reward calculations. And what you're looking for is the only high probability trades. You want to throw out all the other potentials and only stay with high probability trades. So you would find your high probability trades in a defined uptrend or downtrend. The better the defined trend, the better the quality of the trade. Now, when we're looking to enter a market or we're in a market, we have to be sure that we can understand what price is doing. And if we understand, if we take for granted that a well-defined healthy trend is a series of pushes up to higher highs, eases down to a higher low, pushes back up, making the zigzag fashion, and we understand this, that we don't panic when the market starts coming down a little bit and run out of the market. And we can also use this for buying opportunities. So these are what we call retracements. So the ability to point out the difference between a retracement and a potential reversal is a great tool to add to your trading arsenal. Many inexperienced traders, along with some of the most experienced traders, are still unable to detect the difference between an asset's retracement or a potential reversal. This is why the focus of today's webinar is to provide you with the information and knowledge needed to accurately determine whether an asset trend is forming a retracement or preparing for a reversal. So let's start off with a couple definitions. A retracement are momentary reversals that occur during a longer trend. Unlike reversals, retracements show a continuation of an opposing trend within a targeted asset's price action. In other words, we have an uptrend and it is moving opposed to that trend, but only for a short period. So we're making the push and the ease, the push, the ease, the push, the ease. Now, granted, my chart here is a little bit too nice because assets don't move in this push, ease, push, ease, push, ease, push to the top and then reverse and go right to a downtrend. Most likely, you're going to get all kinds of a change to this trend. It's going to lose some momentum. It's going to go into some sideways action. Because remember, 3 ways: uptrend, downtrend, sideways. The markets spend more time trading sideways in a congestion than they do with uptrends and downtrends. But if you're in the market, being able to spot that reversal is critically important so you don't lose your shirt. So reversals are temporary changes in an asset's trend that occur over a short period of time. Oftentimes, reversals can last minutes, hours, or days. It just depends on what time frame you're utilizing for your charting. Reversals are oftentimes dramatic and do not represent a long continuation of the opposing trend during the asset's price action, like seen with the retracements. Now, Wall Street is chock full of investment idioms, but perhaps none is as broadly quoted as cut your losses short and let your winners run. Now, this is a lot easier said than done, but how, in fact, is an investor to know whether an asset is merely retracing against an existing trend or if the trend has outright reversed? Successful investing is predicated on knowing the answer to that question. So we need to be able to precisely know and see the difference between a retracement and a reversal. Now, there is no real fundamental explanation to define and tell you when to find a retracement. There's no real rules because retracements can occur at any time for any reason, and so can reversals. It's really just a sentiment of the market, and spotting these can be quite difficult. So when price reverses, most traders or investors are faced with 3 tough decisions. What are you going to do if you're in the market? You could hold throughout the sell-off, which could result in the losses if the retracement turns out to be a larger trend reversal. Or you could sell and then rebuy if the price recovers, which is a big waste of money and points because you might not be able to get right back in where you got out. Or just sell permanently, which could result in missed opportunities. So by properly identifying a movement as either a retracement or reversal, we can reduce costs, limit losses, and preserve gains. So I've got a little presentation prepared for you that'll help. It's usually visually easier. Actually, before we go over there, let's go to a live chart. Okay, and let's see if we can see this on live charts. Okay, we're looking at right now the current euro-US dollar. Okay. This is an up to the minute chart. And we can see that the euro is coming off of a downtrend. So we can see the push, the ease, the push, the ease, the push, the ease, the push, the ease. Now, a downtrend is defined as pushing to lower lows and then lower highs. In other words, pushes down, forms a lower low, moves back up and forms a high, is lower than that high. Pushes back down to form a lower low. This low is lower than the lowest point. Moves back up to form a lower high. Pushes back down to form a lower low. Back up to push a lower high. And ultimately down to form the lower low. So what do we have? We actually have steps. And this is in the life cycle of a trend. Okay, when this trend, we would have never known that this was a bottom. There is no way to predict that price in that bottom. Yes, there's support and resistance. They're all kind of technical indicators, but we could have never pinpointed that bottom. You know, it's like the markets call it catch a falling knife. But when the asset came back up here and started forming a higher low than its previous lower low, it's one of the first clues that we are no longer in a retracement, but moving to a reversal. We can see the markets moved all the way up here and then retraced, moved up, retraced, moved up. And so these aren't pretty pictures. They're not easy to see, but if you believe and you follow the peaks and the valleys, you'll see these pushes and eases. So I've got this presentation set up, and let's see if we can explain to you why this happens so that you feel more at ease when you see them and you don't panic and sell. So Fibonacci are one of the ways that we can help understand price action and determine if the assets are retracing or reversing. So on the chart we see in front of us, we can see a beautiful uptrend. Push, ease, push, ease, push, ease, push, ease, push, ease. At this point, it went into a little bit of congestion. Okay, and again, like I said, this is what happens. The market goes into congestion, but then it eased back down. Where did it ease back down to? It eased back down to, number one, our major support level, as well as the Fibonacci level at 38.2. Okay. Now, at this point, we would like to see the asset move back up and start retracing back up to form a higher high. Okay. If it doesn't and it breaks through here, most likely we are looking at a reversal. But as long as we see this bouncing up here, if we were in that market, we would feel comfortable remaining in that market so that we can ride out our price. Okay. Now, if it comes up to this resistance level and bounces off of it, maybe it's now moving into a reversal. But what we had predicted was a move up, a move down, and this is exactly what the asset did. Came down to that major support level on the Fibonacci level and bounced off. So this is then a very well-defined uptrend that's continuing its momentum, and at the same time, it is giving us the retracement. Now, if we were in the market, we wouldn't be panicking to exit the market, and if we were one of the buyers who had sidelined, we would at this point perhaps, or when it bounced off here, because we'll never find this exact point, we would have then been one of the buyers re-entering the market that's going to help to give the momentum, the asset to move up. But this is what a well-defined trend does. Now, I've given you two handouts tonight. On your screen, you can see two little download buttons. One is a guideline that I put together, a guidebook I put together for you called Retracements and Reversals. It'll cover in more depth what we're talking about in class and give you more examples and give you something that you can look at later. Okay. Then I've also given you investing.com Introduction to Technical Analysis, which is an extremely good book. You know, it's, I think, about 30-some pages long, but it'll go in and introduce you to technical analysis and all the tools and explain to you exactly how to apply support and resistance levels, where to find them, how you might apply other tools, how a trend line is defined, and we'll give you also more information on technical indicators you might want to use to help let you know, and how to use volume also. So it gives you everything. It's a great ebook. Okay, it's not one of those little sloppy promotional things. It's from investing.com, and it is, like I said, solid chock full of information. So click the download button, download it now, because the only way to get it is in this live class. Okay, after this class, it's not going to be available to you. So download them now. Then you can move them around to wherever you want. They're both PDFs. And then you can move them to wherever you want to move them to read them later. But you cannot access them except if you click the download button at the moment. Okay. So I'm going to show you one other asset, and then I'm going to start showing you how you might apply Fibonacci and to find support and resistance levels and how to understand what the market is doing. But see, again, here on Litecoin, you can actually see the price moving in this downtrend and forming lower lows, lower highs, lower lows, lower highs throughout the entire movement as it continues its down. Okay, you know, if you could have gotten in at the top and ridden this down all the way, okay, you could have made a lot of profit. But if you notice here, what happens is it was making this beautiful downtrend, then it moved into this whole sideways mess of congestion. Like I said, this is where the market stays. It stays in this consolidation, this constricted area. Most, not just this asset, most markets stay in this mess that's not decipherable. So the question is, if you were riding this downtrend, would you want it to have sold out here, or would you want to ride it down? Because we're expecting it to return down to the bottom trend and continue riding on. Okay, so there's many ways that we can do this by drawing the channels, and a channel is part of a chart pattern. Okay, we've actually defined a very well, beautiful channel at prices staying in the middle of, and using this to help us define these retracements. Because the channel, if the price breaks out of the channel to the top or the bottom, then most likely we're looking at a end of the trend and moving as into a reversal as opposed to staying in that retracement. But you could feel safe when it stays in that channel that you know these are retracements. So the asset just starts continuing down. So there's many ways that we can define this. Understanding trend lines is quite important and trend patterns. And so we're going to watch this on Fibonacci's and how you might want to find entry and exit points. And then we're going to go over and look at a few chart patterns. because reversals can happen at any time. Even though we can use lots of tools to figure out entry points, exit points, stop loss points, and stop losses are very important because a retracement can turn into a reversal in a matter of seconds, and you could lose all your profit and lose your a lot, and end up with a loss. Because basically, when the market moves against you, you only have three options. One is to sit and hold, ride it out, and hope it comes back. Two is to jump out of the market, and three is to move to the sidelines. But you don't have much of a choice. So being prepared is very important. Now, there are many tools now. We've looked at tonight Fibonacci retracements. We have pivot point support and resistance levels, and trend line support and resistance levels, and chart patterns. Now, pivot points are one of the easiest ways to get support and resistance levels. Pivot points come from a pivot point chart. Okay. And if you don't know what pivot points are in support and resistance, we have other classes to help explain all those to you. But once you get your pivot point charts and you get your support and resistance put on your charts, you can then use those to monitor the movements of the asset to see whether it is moving in a retracement or a reversal. In other words, price moved up, came back down, and should touch this support, this resistance level, the support level, and bounce off of it. Okay. When it breaks that resistance level, we get a little bit worrisome. Okay. But when it falls down to its next support level, we would expect support to hold up the price, and the price move back up, comes back down to resistance level, moves back up, falls back down to support level. So this will help us identify whether an asset is in a retracement or in a reversal. Then we also have trend line support. By drawing your proper trend line underneath your assets, okay, which is, if you don't understand trends and how to draw them, you would draw a trend line underneath your assets, connecting the points in common with no prices having violated that trend line. Okay. That forms support because in an uptrend, price should remain above that trend line, making, as you define an uptrend, making higher high, higher low, higher high, higher low, higher high, higher low, higher high, as it steps up that trend. If we were to take and draw a line connecting the swing highs above the trend line, we can then build a set of support and resistance lines that will help us see whether the price, if the price stays within these support and resistance lines, most likely it is just simple retracements. When it breaks through those, most likely we've moved into a reversal. Then we also have chart patterns, like head and shoulders. A head and shoulders pattern is a true reversal. It takes a while for a head and shoulders to form, but once we see the formation of the left shoulder, the right shoulder, the head, and price breaks through that neckline after the right shoulders form, it's telling us that the price is now in a reversal. And this will help us get out of the markets or get in the markets. Okay. Chart patterns have an established definition and a criteria, but there are no patterns that tell us with 100% certainty where a security is headed. After all, the richest man in the world would be a trader in the case rather than an investor. The process of identifying chart patterns based on these criteria can be subjective in nature, which is why charting is often seen as more of an art than a science. But a head and shoulders is a very complex pattern, and when it plays out, it is usually very true. Then we have chart patterns like triangle, symmetrical, ascending, and descending. Okay, these are formed as price is making its higher highs and higher lows, but the depth of these higher highs and higher lows are getting smaller as price is pushed into the apex of a triangle. Now, a triangle doesn't give us directional move. Okay, we're looking for a breakout. Okay, and it will help us time that breakout. And if price breaks out of the triangle upward, okay, it's going to have a certain momentum. If it breaks out downward, it's an opposite the trend, then we know we have a reversal. Now, we have whole classes on trend patterns because triangles are my favorite trading tool, but you have to understand what they're telling you and how to use it. So remember, technical analysis is the study of historical price performance in an effort to predict future price performance. Price is the only accurate measure of investor sentiment. It is the intersection of supply and demand. Investor sentiment is at least and possibly more important determinant of price than any fundamental factors. Now, there are three important principles that govern technical analysis. First, price is not random. Second, price anticipates fundamental changes. And third, the relationship between price and time is linear. Different strategies have varying degrees of success depending upon where the market is in a bigger time frame. Technical analysis is a strong uptrending market will show the basing patterns are frequently broken to the upside, forming a stair-step chart pattern. What's the stair-step chart pattern? Push, ease, push, ease, push, ease, push, retracement, push, retracement. This is a strong chart pattern in a strong market. However, the same trader who continues to use this pattern without recognizing that the market has now lost momentum and is in a basing phase will not have the same success. Traders will find that breakouts do not carry as far and that many breakouts start to fail and become losses. But triangles are among the most popular chart patterns used in technical analysis as they occur frequently compared to other patterns. The most common types of triangles are symmetrical, ascending, and descending. Now, as a trader, you need to be able to differentiate between retracements and reversals. Without this knowledge, you risk many things such as exiting too soon and missing opportunities, holding on to losing positions and losing money and wasting money on commissions and spreads. By combining technical analysis with some basic identification methods, you can protect yourself from these risks and put your trading capital to better use. So remember, I put together that handout for you on retracements and reversals. Please download it now. It will give you more detail of what we talked about tonight and show it to you in examples that you can use to study at home. And also make sure you download that Introduction to Technical Analysis from investing.com. If at any time you need help with this, if you go to www.ubcfx.com, you can click on their Education Center and find all the information you need about retracements and reversals, trends and trend patterns. And you can also talk to a financial analyst one-on-one who will explain it to you personally and help you get through this and understand trends and how a trend moves. Okay? Or come to some of our other classes. So on that note, I'm going to say goodnight to everybody. Thank you very much for joining us, and thank you for supporting UBCFX. Have a great trading night. Bye now.